Welcome to The Explainer. Today, we're jumping right into a fast-paced, no-holds-barred financial teardown of Game Your Game Inc., ticker symbol GYGY. So, what exactly is Game Your Game? Basically, they're a venture-stage golf tech company that somehow ended up publicly traded. Their grand promise is to build the ultimate AI-driven golf performance ecosystem under the brand GameGolf. Their flagship product, the GameGolf KZN AI, combines physical hardware with some incredibly sophisticated software. Think about what the golfer actually experiences out on the course. You've got GPS positioning and club sensors that are seamlessly talking to accelerometers and gyroscopes in real time. Literally every single swing triggers automatic shot detection, which then feeds raw telemetry into a neural network classification system. This is way beyond just a digital scorecard. We're talking about deep, AI-powered performance analytics designed to act like a virtual caddy right in your pocket. Now, the entire crux of their valuation rests on a very specific evolution of their business model. For GGYG, the physical hardware is really just a Trojan horse. The idea is that a customer installs the sensors on their clubs, goes out to play, and generates massive amounts of hyper-specific proprietary golf data. That unique data then feeds directly into a subscription software tier offering ongoing AI coaching. This pivot to a SaaS, or software as a service model, is where the real money is supposed to be made. In theory, it's far more lucrative than a one-off hardware sale because it brings in predictable, high-margin, recurring revenue month after month, year after year. And on paper, their underlying data moat sounds absolutely incredible. This technology has reportedly been used across over 140 countries, with more than 36,000 courses mapped and a staggering 300 million shots tracked over the platform's lifetime. That historical dataset is a potentially massive competitive advantage. You know, in the world of artificial intelligence, data is the new oil. A neural network trained on 300 million real-world golf shots is fundamentally going to be smarter and far more predictive than some rival startup launching today with zero data. That massive repository is the absolute foundation of their entire AI pitch. But, and this is a huge but, when we pull back the curtain on the actual financials, the reality is brutally different from the flashy tech story. Sure, top-line revenue grew 293% from 2024 to 2025, but the absolute numbers are staggering for all the wrong reasons. Worse still, their gross margin completely collapsed from a really healthy 84.5% down to an abysmal 8.6%. Think about what an 8.6% gross margin actually means for a business that's trying to become a dominant software company. It means they're fundamentally losing money just producing their basic goods, long before they even start thinking about paying their engineers, their marketing teams, or their executives. And alongside that collapsing margin, they're still carrying a massive net loss approaching $800,000. $58,505. I really just want to pause for a second to let that number sink in. That tiny number represents their entire total revenue for fiscal year 2025. We're talking about a company that at one point commanded a roughly $25 million market cap, yet they're bringing in the equivalent revenue of a small suburban lemonade stand. It's honestly kind of absurd to juxtapose their grand global AI ambitions with a top line that barely rivals your neighborhood coffee shop. What's genuinely fascinating, though, is how that revenue actually breaks down. Remember that intended business model we talked about, that grand pivot to high-margin SaaS? Well, despite pitching themselves as a sophisticated software ecosystem, they are currently surviving almost entirely on minuscule hardware sales. Hardware accounted for nearly 95% of their tiny revenue base. Software subscriptions brought in just over $3,000 for the entire year. To put that into perspective, $3,000 is barely enough to buy a used golf cart, let alone fund the development of a global tech ecosystem. The software narrative, it simply isn't showing up in the bank account yet. Now, they do have a potentially valuable international footprint, anchored partly by subsidiaries over in Ireland. The U.S. makes up just under 57% of revenue, with other foreign countries contributing a very solid 41.6%. But we really have to step back and ask a serious, rhetorical question here. How on earth does a company with roughly $58,000 in total revenue effectively support, service, and maintain users across the United States, Ireland, and 140-plus other countries? Having a global footprint sounds phenomenal in a pitch deck, sure, but without the revenue to actually sustain it, it's just a logistical nightmare and a massive drain on very limited resources. And this right here is where the investment case starts to severely crack. By the first quarter of 2026, revenue did increase 214% year over year. Awesome, right? Not exactly. That tiny bump in revenue triggered a terrifying 380% explosion in their net loss. rocketing from roughly $147,000 to almost $705,000. The business has simply not demonstrated any operating leverage yet. Operating leverage just means that as a company sells more products, its revenue grows faster than its costs. Here, we're seeing the exact opposite. As they desperately try to scale, their costs are growing significantly faster than their sales, digging that financial hole even deeper. The absolutely crucial point here is a staggering $1.88 million working capital deficit as of March 31st, 2026. A working capital deficit essentially means their short-term liabilities completely dwarf their easily accessible assets. They owe way more money in the near term than they can actually get their hands on. This is not a fortress balance sheet. It's a highly fragile, capital-dependent one. GYGY absolutely cannot fund itself comfortably through its current operating assets. To put that deficit into brutal perspective, we have to look at their cash position. They reported just $286,000 of cash on hand. Now compare that to their Q1 operating cash burn of roughly $291,000. Think about that. Their entire cash balance couldn't even cover a single quarter of their historical operating burn rate. If a company is burning $291,000 a quarter and only has $286,000 in the bank, they are quite literally running on fumes. It's a ticking clock, creating an intense, immediate need for an aggressive cash infusion just to keep the lights on. Unsurprisingly, this introduces massive going concern risks. Management's own SEC filings explicitly admit they need financing just to survive. When auditors issue a going concern warning, they are literally questioning whether the company will still be alive in 12 months. Historically, GYGY has relied heavily on toxic debt and related party financing, stuff like convertible promissory notes and massive warrants issued to firms like Street Over Capital. Let's translate what that means for everyday investors. Issuing massive warrants means you're giving lenders the right to buy shares at deep, deep discounts. For a company with only around 14.4 million outstanding shares, this guarantees that everyday shareholders are going to see their slice of the pie shrink dramatically as those lenders convert their debt into stock. Understanding the corporate history is critical to piece this all together. This isn't some fresh-faced startup stepping onto the stage for the first time. They were acquired by InPixon in 2021, divested to Graffiti Group in 2024, and finally landed on the NASDAQ in July of 2026. But the key detail is how they got there. It was a direct listing. In a traditional IPO, a company issues new shares to raise fresh cash. But in a direct listing, existing insiders are simply registering their own shares to sell on the open market. The listing itself didn't raise a single dime of primary capital for the company. Doing a direct listing when your balance sheet is literally starving for cash, that is a massive blinking red flag. So, unsurprisingly, this highly speculative setup combined with an extremely low float of tradable shares led to a vicious 94% collapse in the stock price. The stock actually spiked to $32.66 shortly after listing, but in the world of microcap investing, low float and highly speculative narratives almost always cause these massive, temporary boom and bust cycles. Once the initial hype faded, gravity took over and the stock crashed down to the $1.76 range by mid-August. It is a textbook lesson in why you have to look past the ticker tape and rigorously analyze the underlying balance sheet. Yet, despite this total financial horror show, the underlying market size is exactly why speculative, venture-style investors are still circling this microcap. The structural trends in golf are phenomenal right now, and golfers are completely obsessed with data and improving their swing. Walk through the math with me for a second. If GYGY captures just 1% of the 29.1 million US on-course golfers, that's roughly 291,000 users. At a hypothetical $100 annual software fee, that equals $29 million in pure high-margin recurring revenue. Hitting that target would entirely change the economics of the business overnight and instantly justify the valuation. But they aren't operating in a vacuum, right? Capturing that 1% is going to be incredibly difficult. When you look at the competitive landscape, this is a true David versus Goliath scenario, except right now, David doesn't even have a slingshot. Giants like Garmin and Arcos already possess the massive scale, the deep data moats, and the excellent distribution networks that GYG so desperately needs. A golfer can already go out and get GPS tracking, club sensors, and AI analysis from established, highly profitable companies. Breaking into that entrenched market requires massive distribution, which GYG simply doesn't have yet. Suddenly, though, a real beam of hope appears. On August 11th, GYG announced an initial quarterly purchase order for 500 GameGolf KZN AI units from GolfSuites. This is a massive lifeline. It could finally validate their B2B or business-to-business distribution channel. This order isn't just about the immediate hardware revenue. It's about survival. It's about proving to the public market and, crucially, to potential lenders that someone actually wants to buy this product at scale. If that pipeline expands, it secures hundreds of thousands in hardware revenue and establishes that vital subscription tail they need so badly. And that sets up the ultimate climax of this whole GYG story, the broad commercial launch of the KZN AI product, targeted for the end of September 2026. In microcap investing, events like this are literally life or death for the equity. This is a make or break, totally binary commercialization bet. The entire investment thesis depends overwhelmingly on whether this beta product successfully converts into a scalable hardware and recurring subscription business right now. If it fails to launch successfully, the company may simply run out of time and capital. Game over. So forget the flashy marketing headlines going forward. As an investor, these are the exact ruthless metrics you need to track to see if the launch is actually working. We need to see units sold cresting 1,000 per quarter. But more importantly, we desperately need to track the hardware to software attachment rate. Selling hardware is just a one-time, low-margin pop. We need to see what percentage of those hardware buyers are actually subscribing to the software, because that software is the high-margin annuity that builds true enterprise value. And we need to see gross margins pushing 70% on that software side to prove the SaaS pivot is actually real. Now, when we evaluate valuation, the disconnect is absolutely staggering. Even after the stock collapsed down to $1.76, which represents a roughly $25.3 million market cap, you have to compare that to their $58.5 thousand in total revenue. That means you're paying approximately 432 times trailing sales. To put that in context, hypergrowth, megatech giants dominating the global economy trade at a mere fraction of that multiple. Yet this company is demanding that massive premium while effectively earning coffee shop revenues. You're paying heavily for a venture-style future that simply hasn't happened yet. Looking ahead to 2030, our deep dive analysis models out several scenarios. And honestly, the risk is severe. We assign a 45% probability to the bear case, where the launch fails to gain meaningful traction and dilution just spirals out of control to pay the debt. In this scenario, you face near total capital impairment, meaning you lose almost all of your invested money, with shares dropping down to 20 to 50 cents. Our base case, at a 40% probability, shows modest traction pushing shares into the $2 to $4 range, but you must expect extreme, gut-wrenching volatility along the way. But here's that venture-style allure that keeps people hooked. If they perfectly execute their AI SaaS pivot, and if they somehow conquer the data layer of global golf coaching, a rare bull scenario emerges. In this scenario, revenue scales past 50 million, and you could see exponential upside, driving share values anywhere from $10 to $18 or more. However, we have to deliberately balance this excitement by reminding ourselves of the real-world probabilities. The math models this bull case at only a 15% probability. It requires completely flawless execution from a company that is currently running on fumes. So ultimately, our 9 out of 10 conviction rating is a resounding avoid. The technology concept is genuinely interesting, and the data moat certainly has potential. But the public equity market is asking everyday investors to finance a business that's still trying to prove it can commercially scale without bankrupting itself in the process. The stock price is just completely ahead of the underlying business right now. If you're watching this stock, the prudent move is to keep your capital safe on the sidelines until management actually proves they can execute. Put it on a speculative watch list and just wait for the hard data. So, I'll leave you with this final thought. Will their September launch truly revolutionize the fairway and capture that massive AI software potential, or will this just be another painfully diluted lesson in micro-cap gravity? Keep a really close eye on those Q4 subscription metrics. That is exactly where the real story will be told. Thanks for hanging out with me for this explainer.